Finance is one of the most important things that you need to get right. And when it comes to finance, making a simple decision either way can cost you thousands, or if you make the right decision, it can save you thousands. We want to link the finance back in as well with the importance of working with a premium level mortgage broker, because they're the person that's going to help you get your finance done, find you the best deal, make sure it matches your situation. Because remember, everyone's different. Everyone's got different needs, requirements, and responsibilities. So you need to make sure that whatever finance deal you get is going to match your situation and have it structured the right way to maximise all your benefits, all your tax deductions, and all the interest savings and offsets that are available as well. So let's have a look at some of those things now and some of the key things you need to understand when it comes to finance. Right, the first one is loan to value ratios. You need to understand what an LVR is. That's the definition there, and this is how we work it out. So we've got a property worth 500K, our loan is worth 400. That's the formula. There's the example. So our LVR is 80%. That means that the loan amount is 80% of the value of the property. And we use our LVR to then work out some further things like what our available equity is. So equity is the difference between the value of the property and the loan amount. So this example, our equity is 180,000. But our available equity, which is what we want to be able to access to then do things with, like invest in more property or purchase cars and holidays, those sort of things, all with different tax implications, of course. We want to work out how to figure out our available equity. So in this example here, our loan amount is 320. Our LVR limit is 90% of the value. So that means that our LVR was 90%, which means we put down a 10% deposit. So to work out our available equity, we go 90% of the value of 500K is 450,000. 450 minus 320 gives us our available equity of 130,000. And the bank will keep 50K as their security. That means there's 130K available to us to borrow against that property to then use as deposit or deposits for more property. And that's how we accumulate property. Okay, so what sort of structure works best? Well, quickly, before we move on, if we go over 80%, i.e. we borrow more than 80% and put down less than a 20% deposit, we will pay lender's mortgage insurance, or LMI. I don't mind paying LMI because what that means is that it's allowing me to borrow more money and use less of my own. Borrow more money from the bank to then buy more property and use less of my own funds. And the LMI amount is usually about 2% of the borrowed amount. And you can borrow that from the bank as well. So the first thing we want to do whenever we look at finance is have a look at what our borrowing capacity is. That's the definition of borrowing capacity right there. How much money the lender assesses that you can afford to borrow based on your disposable income. How do we work out borrowing capacity? Well, firstly, we look at what our income is. Income's going to be along the side here. And then we look at our cost of living. Where do we live? Are we renting? Are we paying a mortgage? Do we have any personal debt? Do we have any kids? Because kids are expensive. What credit cards do we have and what limits do we have on our credit cards? And then what's left over is our disposable income. And from that, they'll work out what our borrowing capacity is. This is what your mortgage broker will do for you. A slight reduction in your credit card limit can have a huge difference to your borrowing capacity. So if you have a credit card limit with 20,000 on it, but you only ever use 5,000, then reduce your credit card limit because it will increase your borrowing capacity with the banks. Okay, so these are the kind of loans we can get. We can get a principal interest loan with a redraw facility. As an investor, though, we love interest only and offset accounts. And I'll run through both those now and why we love those. So principal interest, or P&I. This is how it works. There's our loan amount of 400,000. Our monthly repayments to the bank are going to be about 2,500 at 5%. And that'll be split between principal and interest. The principal payment of 500 reduces the loan by $500. And that will, each month, continue to reduce the loan. The interest payment, that goes to the bank or the big abyss. We never see that again. That's just our fee for having the loan. Over time, though, As we reduce the loan, our principal payments increase and our interest payments decrease. And then we can track that on a calculator to see exactly how long it's going to take to pay off the loan. And if we pay off an extra $100 a month on top of our principal payment, we can reduce our loan by up to 5 years in time, because it compounds. So $100 a month, you can reduce your loan by up to 5 years. Now, redraw is the ability to access those funds that we've already paid off the loan. So if we paid off $50K and we have a redraw facility, we can then redraw those funds. However, you've got to remember that the bank still controls the funds. So we don't have control of our money. That's why I don't like redraw too much, because the bank can still limit how much you can redraw. They can even stop you from redrawing if your borrowing capacity has changed. So that's P&I. As an investor, I don't like P&I because the principal payments are not tax deductible. It's only the interest payments. So interest-only loans are self-explanatory. Same loan amount, but this time we're only paying the interest. We're not paying the principal component. So effectively, we're saving that $500 per month. Now, you have an offset account linked to your interest-only loan. An offset account is a transactional account, works exactly the same as a savings account, except for the fact that you don't earn interest on the balance. You save paying interest on the loan, depending on what the balance is. And that difference is huge between that and a savings account. Let's say we've saved 50K instead of paying off 50K. That 50K is now sitting in our offset account, which we have full access to. We can withdraw those funds, we can pay bills, we have our salary paid into that account, we have internet banking, etc. So that 50K, the effect of that is that we're now only paying interest on 350, not 400. If the balance here was 100,000, then we'd be paying interest on 300,000, not 400. The loan amount still exists, but the effect is the same as paying it off. Is that you're only paying off, you're paying interest against the balance minus the offset balance. Let's have a look if we had that 50,000 in a savings account. We'd earn 3% interest, which is then taxed, so effectively it's 2%. Our bank account would look like this. With a savings account, we'd have 2% going into our account. With our offset account, however, we're saving 5% leaving our account. 5% leaving our account. So the difference is huge. Offset accounts work really well. If you have a number of properties, I suggest just having one offset account structured against the largest debt or your own home, because remember, your interest payments on your own home are not tax deductible. But again, your mortgage broker is the key person to make sure you're all set up the right way. So I hope that helps with the finance tips. Again, for any questions, or if you'd like to follow up or have an appointment or find out some more information, just email information@onpointpi.com.au or give us a call or jump on the website. Look forward to hearing from you soon. Cheers, Nick.